Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. So I gotta say, it's a little bit of a nothing burger today. So it's a default, which is buy stocks. Let's get check in here on where markets are headed. So you get the S&P, the stocks index is down by about 0.3%, but the S&P is up overall. You definitely have the NASDAQ and the Dow all in the green. The Dow actually outperforming as well. Within the S&P, you got the S&P Real Estate Index. That's the best performer, up by 2%. Then below that, you have the S&P Energy Index. And then you have utilities. So I don't know what you make of that. A little bit of cyclical and a little bit of safety and defensive, all kind of lumped in, leading the S&P higher. And the 30-year yield is down 3 basis points. We had a super solid 30-year auction. We can clearly take down the supply that's coming out. You're getting a bid all across the curve, Scarlett.
All right, so as you can tell, stocks are higher, bonds are higher as well. So on the face of it, markets are pretty calm as investors await new catalysts to clarify the timing for future rate cuts. But you look under the hood, and it's clear that earnings continue to drive entire sectors, like ARM's tepid full-year guidance, pushing chip makers lower, as you just showed us. But in just over an hour, we're going to be watching for SoundHound AI and Marathon Digital results, and of course, we'll bring those to you. In the meantime, Bloomberg is hosting big names at big events from coast to coast. We're going to be hearing from Reddit CEO Steve Huffman and OpenAI's COO at our B-Tech Summit in San Francisco. Here in New York, we've got the Sell-Side Leaders Forum featuring Peng Zhao, the head of Citadel Securities, among others. Alex?
All right, Scarlett, let's kick things off right now with Peng Zhao, the head of Citadel Securities, speaking right now with our own Eric Schatzker.
Negotiated, but you were still only, as you put it, playing around with the technology, looking for use cases. Where are you now?
So first of all, I think the broader trend of everyone getting fascinated with ChatGPT, and I think Catherine from Bloomberg and I talked not that long ago about how much my daughter and I enjoyed using ChatGPT. I think we're kind of getting over the phase of just playing with it, right? And now we're asking.
The novelty's worn off.
The novelty is wearing off.
Okay.
That's a good thing because we're now asking the more serious question of what can we use this for? The lesson we have learned so far are twofold. We have been finding the most amount of success either to do something that's relatively easy and quick to do and maybe cheap to do that would affect many members of our team. So that's helping them to code more efficiently, helping them to retrieve information, knowledge more efficiently. Those things would affect a large swath of the employees within our firm, and the technology available to do that is readily accessible. Or we use some of the lessons that's learned from the more recent development in AI, but a lot of times machine learning and other areas that's adjacent to generative AI, and we try to solve some of the hardest but highest value problems that we're trying to solve internally.
Such as?
In another word, if you take, let's just say if we go take this group of the highest productivity, highest value add researchers and ask the question of what are they doing that we can help automate and make the loop at which they iterate on their ideas go faster. That's a hard problem to solve, but we're finding just as much success in that because the reward from solving that problem is that much greater.
Whose LLMs have you found useful so far?
The difference are becoming smaller and smaller.
Interesting.
Yeah.
And
that's a phenomenon where over the last 12 to 18 months, the progress within the latest LLM algorithms, the performance progress has been slowing down. That allowed all the different players to essentially catch up to each other.
There is some excitement about the next iteration of generative AI, whether it's ChatGPT 5 or Anthropic's, whatever. It's supposed to, I guess, extend the capability of the artificial intelligence to decision tree reasoning, what they call Q-star. I am certainly not an expert. Is this something that you're interested in, and do you see applicability to what you do at Citadel Securities?
So I'm interested in it on a technical level and as an individual who's done this type of research when I was in grad school. But from a business perspective, we will react after we see it. Nowadays, it's hard to tell what's real versus not until you see it.
One of the things we did talk about as well last year was the potential for AI-powered disinformation to become a real risk in financial markets. For example, to manipulate retail investors. Do you see any evidence of that happening yet?
Luckily not yet. I think the meme-driven stock trading has subsided somewhat. Where that's certainly not been part of the market condition and market story that we're seeing this year. I think that's a good thing. But the other thing we talked about is the upcoming election, and I personally remain concerned about that.
Citadel is one of, I believe, 7 firms backing FMX, the new futures exchange being launched by Howard Lutnick of Cantor Fitzgerald fame. In fact, some of those firms are probably with us here in this room. Why are you interested in this, and what potential for success do you think FMX really has?
So we've had a history of supporting and backing exchanges. We find the launch of new exchanges a very efficient and effective way of driving innovation, resiliency, and efficiency. And BGC have had a strong track record of launching successful exchanges. So we have done that, and so are the partners, many of them here in the audience. So I think our consensus is there's a huge amount of opportunity for BGC to build on top of the success they've already had with Phoenix in Treasuries and innovate and push the frontier on rates futures forward.
But if the members exchange, after 5 years, has only been able to take mid-single-digit market share away from NYSE and NASDAQ, why does it stand to reason that FMX might do better against CME?
So we would argue the members exchange has been a very large success.
Okay.
Within the period of time that's years shorter than the closest comparison, IEX, it's now have a multiple of the market share that IEX has. It's further driven real innovation in market resiliency and market efficiency, and it's more recently also launched both a options exchange and started its technology outsourcing business. It's been a huge source of innovation and increase an exporter of efficiency and resiliency for the whole market. And we believe FMX will do just that.
2 quick topics to finish with, Peng. The first is Bitcoin ETFs. What has Citadel Securities, experience been so far with Bitcoin ETFs in terms of demand? And
our own Eric Schatzker speaking with Peng Zhao, the head of Citadel Securities at the Bloomberg Sell-Side Leaders Forum here in New York. If you want to check out the conversation and the ones that will follow, go to LiveGo on the Bloomberg terminal. Alex, the old adage, sell in May and go away. Aside from selling, go away seems to be the theme of the day. Volume is down 25% from the 20-day average.
This is what I had a headline on my notes: Wall Street snooze fest. Yes, we're seeing upside in stocks. It feels like the default is just go ahead and buy equities, blah, blah, blah. But you're right. Volume is down. Hard to see a catalyst. It feels tricky to see a catalyst in the equity market till we get NVIDIA. And then for the economic data, CPI. That's miles off.
I know. CPI is next Wednesday, and NVIDIA is about a week and a half away.
Yep.
So, prepare for a lot of days of slow trading. So let's continue the conversation, because coming up, market analysis from Amy Wu Silverman, equity derivatives strategist over at RBC Capital Markets. She's got a lot to say about NVIDIA.
Oh, yeah. Plus, Shopify racking up analyst upgrades on the back of the stock's worst drop on record yesterday. We're going to get into what's fueling the optimism.
And coffee chain Dutch Bros brewing something big. A conversation with the CEO, Christine Barone, about what's next for the company. This is Bloomberg.
I think, again, we are in very, very early days in terms of the capabilities of what this can unleash for our society. Incredibly excited to be part of it, but I don't think we're part of a hype cycle at all. I think there's a lot of innovation taking place, and frankly, the innovation that's taking place and the inventions that we're seeing, it's just breathtaking. So no, I don't personally view it as a hype cycle at all.
That was the ARM CEO sharing his big expectations for AI, and investors are eyeing those artificial intelligence players ahead of NVIDIA's much anticipated results on May 22nd. Our next guest says, interestingly, this is the first time we have not seen exuberance from the options market ahead of NVIDIA earnings. The woman behind that call, Amy Will Silverman, equities derivatives strategist over at RBC Capital Markets, joins us now. Okay, if there's not exuberance, is there negativity and pessimism? Like, are we looking at puts on NVIDIA right now into the numbers?
So we're not, but sometimes it's this lack of excitement that's actually kind of exciting. It's kind of interesting because, Alex, since May of last year, the call option demand on NVIDIA was through the roof, like historic, unseen before. And so the fact that we've actually seen this exuberance sucked out of the market, that right tail being absent, to me is very telling because it is a noticeable shift in sentiment from what we've seen all these past quarters.
But NVIDIA doesn't report earnings until May 22nd. So there's time for that narrative to change or that mood to change as well. Do you tend to see big swings in mood changes when it comes to a company like NVIDIA?
So it's interesting, you are right, especially these days with zero DTE, that 2 weeks in options may as well be infinity. But what I've seen happen is, especially with the other Mag 7 having reported the last few weeks, usually NVIDIA sentiment stays stable, but it hasn't this time around. We actually started to see it inflect during Meta's earnings, during Google, Apple's earnings. And so to me, that was interesting because there was actually shift in option sentiment sort of as a prelude to this earnings, which is coming up.
So what does that tell us about the numbers? As in line good enough then to move?
I think in some ways it tells us that we can't just rely on the FOMO and the MOMO and the AI frenzy, which to some degree has been what we've seen from the derivatives market, and some of that momentum has kind of begat more momentum. We can't rely on that tailwind, and that definitely has been a tailwind, Alex. I think it does have to be idiosyncratically the stock does well, that bar has to meet that expectations because you're not getting that tailwind from options, which has usually kind of kept that steam going.
So interesting. So are we seeing exuberance tied to other AI plays? I mean, NVIDIA is not the only one out there. It was kind of the original one, but there's a lot of excitement attached to AMD. There's a lot of excitement attached to MicroStrategy. Of course, that's a whole different animal on its own. But do you see that playing out elsewhere in some of those names?
So I will tell you, what I think is fascinating is this inflection in sentiment has been not unique to NVIDIA. I think we focus on NVIDIA because it's one of the few that hasn't reported, and it's also a proxy for sentiment. But Supermicro, for instance, was another one where we saw what we call skew inversion, so that historic demand of call options outweighing put options. We've seen some of that sucked out of the market too. We've seen it sucked out of the market in terms of Mag 7. The way I would read this is with that exuberance gone, the bar is just that much higher. And the second part of that is folks who have historically been a little afraid to hedge because it's sort of like the train just keeps running in one direction. You're kind of seeing them poke their heads out as well, which is, again, not saying things are bearish, but you are seeing that shift in sentiment speak for it.
So what are the trades right now?
So we sort of have three broad trades that we think are interesting. In terms of Mag 7, something simple like a QQQ hedge using puts or put spreads. I cannot, just the historic level of cheapness in the left tail is stunning, Alex. So the volatility of VIX it's dropped to its 0th percentile. It can't go any lower, And then the other one in terms of IWM, so sensitivity to that Russell 2000, if we believe in a left tail of even rate hikes or just rates higher for longer, we just don't see that baked into any of these indices. Really, people have not been focused on the left tail, but we continue to see risks bound.
What does that tell you that, given the uncertainty that's out there, whether you're talking about the economy or geopolitics halfway around the world, even fundamental risks, given how much and how far prices have rallied, what does that say about sentiment and the fragility or the durability of the gains that we have posted?
I'd say one, I think there's a little bit of complacency. And two, there's a little bit of this aspect of market structure and options has changed a lot, and some of it is being masked. So there are these themes that we've talked about since the beginning of 2024, volatility suppression, the idea that zero day to expiry trading has made all the activity, all that tenor shrinkage come so close kind of intraday that something like headline VIX doesn't really tell you the nervousness we feel short term. And so these technicals are sort of masking the risks. And third, just because it has not worked in the past in terms terms of geopolitical risks or hedging doesn't mean it couldn't work in the future.
Right. I mean, it hasn't worked in the last however long, but that could always change, right?
Yeah.
Amy, really appreciate your joining us.
Thank you.
Amy Wu Silverman is equity derivative strategist over at RBC Capital Markets. How many times have we heard people talk about the VIX being broken, how it's not really a signaling tool anymore?
That's why I wonder, I mean, if you want to look on a macro level, if you can't understand the skew and stuff like Amy does, do you need to look at gold? Like, is that now a good reflection of safety? Or is that just straight up like China's central bank is buying some gold and that's what's moving it? Like, are there other things you can look at to help judge the underlying risk? Or it's just like the lack of performance in small caps at the end of the day?
No, it's a good point. And of course, because of the option structure market structure changing so much, it's so easy to buy options on your Robinhood app, right? So you don't really have to think through any of this stuff. You just buy.
Yeah, no, I don't do that. But I know some people do. I'm sure Robinhood people do. Yeah, why not?
No, we don't do that.
We don't do that. Also, because I don't know what I'm doing. So there's that.
All right, coming up, online retailer Shopify may have disappointed in the first quarter, but some analysts are still finding upside to the stock. We've got that in our top calls. This is The Close. It is time now for our top calls. Look at some of the big movers on the back of analyst recommendations. And let's start with Cheesecake Factory, an upgrade to outperform from market perform over at Raymond James, which set the price target to $42 a share. The analyst says the restaurant chain's first quarter results showed encouraging same-store sales resilience despite softer industry trends. He says margins have risen beyond pre-pandemic levels again, giving some upside to the stock's low valuation. The shares right now up by more than 5%. Affirm next in line. JP Morgan lifting the buy now, pay later company's rating to overweight from neutral. Disappointing quarterly sales from Shopify spurred a sell-off and overshadowed Affirm's earnings beat. The analyst, baffled by the reaction, urging investors not to let a good sell-off go to waste. Now that he sees an attractive entry point, the shares up, as you can see, by more than 8% on the day. And let's end things on Shopify, the Canadian e-commerce retailer getting a few upgrades after its first quarter report, including one from Piper Sandler. Analyst Clarke Jefferies feels that Shopify's profit expectations and valuation were more right-sized. There are a few areas that could drive a thaw in sentiment, but not enough to justify an underweight rating. He lifts his recommendation to neutral with a $63 price target. The stock just trading below that right now, off by a third of 1% at $62.50. And those are some of our top calls. Now, we're happy to say that the analyst behind that call joins us now, Clarke Jefferies, senior research analyst at Piper Jaffray, covering commerce and industrial software. Clarke, good to speak with you. What did you see from Shopify that prompted the analyst action?
Yeah, certainly. So the most important update we got was on profitability and the growth in operating expenses. I think it's helpful to think about the context of last year. Last year was a year of incredible progress on profitability, and we think expectations on shares were getting a little bit elevated into the end of the year. Thus, our sell rating at the end of the year. We now have 2 data points of operating expense growth after the company restructured and sold its logistics business. And we now have a more realistic operating expense trend. And so really at this point, we think that the elevated expectations are out of the numbers. Consensus and buy-side expectations have now converged. And so from here, we think we can get more productive on estimates.
So Clarke, the way I understand this company, if I just dumb it down for me, is that if I want to sell anything online, I have to use that software. Do they have any viable competitors? Because if not, it's just a matter of how long can e-commerce grow and how much can they make on it?
Yes, there is a field of competitors. I would say that there's a more substantial technology in the upper end of the market, certainly in the enterprise. A lot of the lower end part of the market is evolving in terms of e-commerce functionality. Vendors that provided website services, kind of up-leveling into e-commerce functionality. But this is a vendor that has a substantial share already of the North American e-commerce market. So valuation expectations are built off of a different level than say a starting point of 0.
I got to ask you also about Shopify selling the majority of its logistics unit to Flexport. What's the thinking behind that, and is that going to pay off down the line in the long term?
So I would frame the logistics business as a very difficult business to get scale and get margin in. I think that there was obviously a big incentive to solve a big friction point for merchants, and it made sense from a strategic standpoint. But I think it was a difficult thing for investors to right size in terms of the ultimate margin potential for the business. And so I think part of the outperformance you saw last year was alleviating that concern, that overhang on what the margin structure of the business could be with logistics. And so, huge progress during 2023 was on the back of that sale.
So Clarke, medium term, what kind of growth profile are we looking like for a company like Shopify? And then what kind of free cash flow margins are we looking at?
Yeah, so, this is a company that will probably still grow within the 20% range in terms of gross profit growth, rough revenue growth. The company was targeting low to mid 20s in terms of Q2 organically. And so, I think that's still in play here. The free cash flow margin is the backstop, and why we wouldn't have kept a more negative stance. The company is going to be at least a low double-digit free cash flow margin, company for this year. And so, the broader context here is, this is a more than $8 billion run rate revenue company that's grown for 4 quarters over 25% organically. So, still think of it as a very premier tech asset. Mm-hmm. We're just now at a point where expectations and numbers are in the right place for maybe getting, a more equal balanced stance.
All right, Clarke, really appreciate it. Thanks for jumping on with us today. Clarke Jefferies over at Piper Sandler. I was talking to Anurag Rana, Bloomberg Intelligence, yesterday on Shopify. Man, he could not say good enough things about Shopify, just in terms of the innovation and how good the CEO was and everything. It was amazing. Like, he doesn't dole out those compliments that quickly, but just the idea that this is like a revolutionary major player.
Yeah, praise is hard to come by from him. But one thing I think that you really encapsulated nicely was that Shopify's prospects really just lie in e-commerce. As long as people continue buying on their tablets or their phones, this company will benefit.
Here's something I always think about. If you were going to sell something online and like make something, what would it be? And have like a store?
Yeah, I need to.
What would that be?
If I figured that out, I probably wouldn't be here.
No, it would be like sport. You'd be something like sports memorabilia, like sports retail sale thing.
Let's wait for the Rangers to win the Stanley Cup. I think I shouldn't have said that out loud, and then we'll come back to that.
Okay, we'll do that. I was thinking like secondhand clothes. I don't know. Anyway, coming up, you get a standout quarter from Dutch Bros. And also the expansion plans are going to be huge. Starbucks warns Dutch Bro does really well. We're going to talk for Christine Barone, the president and CEO, next. This is Bloomberg.
It's just about 3:30 p.m. in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Alex Steele. Like I said, volume really light. Yes, stocks are higher, but let me tell you, it definitely feels like we're going to wait for NVIDIA for any equity market action. It's like Wall Street on snooze.
That's like a week and a half from now.
Hey, man, I don't know. Maybe you Mish tomorrow. We'll do something. I like University of Michigan. Maybe a CPI next week. Individually, though, on earnings, we're definitely getting stocks that are moving. And one stock is Dutch Bros. It's up almost 19% this week after a quarter that one analyst called a fairly impressive report. It's also going to offer up new seasonal beverages and expand in states like Florida and the South. And joining us now for more is Christine Barone, President and CEO of Dutch Bros. So we're not familiar with Dutch Bros in New York. You like the South, fine, whatever. We'll get to that in just a moment. But can you just describe to me your growth profile for the next year and how it's looking?
Yeah, absolutely. We love the West Coast as well. We started in Grants Pass, Oregon. We have 876 shops now at the end of Q1 across the country. We opened our first 2 shops in Florida, and we're really continuing to expand coast to coast. So from California to Arizona to adding shops in our existing markets to going more into Florida, going more into Tennessee. So lots of growth plans in front of us. We're projecting to open about 150 to 165 shops this year.
Wow. I find that so fascinating because I pulled some quotes from some earnings calls from maybe what we'd say some of your competitors in essence. You got Starbucks CEO saying Many customers are being more exacting about how and where they choose to spend their money. Amazon CEO saying that customers are shopping but cautious. McDonald's saying macro headwinds have been more significant than they anticipated into the coming year, yet you're expanding at a very rapid pace. What do you see that they don't?
Yeah, I think that when you look at an environment like this, it is just so important that you're delivering on exactly what your customer wants and what your team wants. And this quarter, we just had, I think, an awesome quarter where we were firing on all cylinders. We rolled out really great new innovation. So we rolled out protein coffee. We rolled out Pop and Boba. Our rewards program, 66% of our transactions are coming through that program. And we're also having great success with paid media and building awareness in new markets.
You mentioned California earlier, so I have to ask you, Christine, about the new minimum wage law for fast food workers there that takes the hourly wage to $20. What does that mean for Dutch Bros? I know that for the industry at large, it's resulted in menu prices going up.
Yeah, absolutely. So we have just a wonderful business in California. We're continuing to open new shops in California. We did take a small price increase in California, like many others did, to look at that. But we're still very pleased with how we're doing in California.
Does it give you pause, though, when it comes to expansion plans and whether you want to continue building out your presence in California, or given the cost structure, maybe it makes more sense to look at other markets?
Well, we're continuing to look at markets really across the country. As of right now, we're continuing to expand in California, as well as all of the other markets that we're in.
So, Christine, I'm sure if I asked Starbucks and McDonald's, are you delivering what your customers really want? They'd be like, totally. Yet that's what you said in answer to why you're able to grow when they're seeing struggles. Is it also how you run your operations? Like, how do you run your operations maybe in a different way than a traditional fast food place?
So I think what's most important to us and what's incredibly core to our brand is our service model. And so every single thing we do starts with our Broista. And we only expand new shops when we have an operator that's been with the company for an average of 7 years to go and open that new shop and open that new market and build a relationship with the community that we're going into.
In terms of maybe other points of inflation, though, like input costs and stuff, we all talk about cocoa, say coffee, et cetera. How do you manage those price fluctuations, and what do you notice that's sticky?
Yeah, absolutely. So those are things we're watching closely and that do move up and down quite frequently within our business. You know, we sometimes lock in things when it makes sense so that we have that steadiness across our business. So we do have a fair amount of foresight into what's coming on all of those commodity prices.
Christine, I got to ask you about Panera scrapping its caffeinated drinks, those charged sips, following lawsuits that they led to adverse, in some cases even fatal, health effects. What was the takeaway for someone like you in terms of how you look at your lineup of drinks and how you roll them out and how you assure your customers that you've done your due diligence and these are safe drinks?
Yeah, absolutely. So we have an extensive process as we're looking at launching new drinks to customers to ensure that they're also going to love them as well. So we do a lot of screening before we launch new drinks. We also have nutritional information that is readily available through our customer service team and also at our shops.
Christine Barone, President and CEO of Dutch Bros. Thank you so much for joining us.
Thanks so much for having me.
Really appreciate it. And of course, neither of us have gone to one, but you are about to embark on a trip in which you might go visit one.
Yes, ma'am. I'm going to Nashville, Tennessee for radio in a couple weeks, and I feel like I'm going to stop by a Dutch Bros.
Yeah. Are you going to get a caffeinated drink, or what's your
I mean, I'll get like a coffee, but like energy drinks scare me. Nothing against Dutch Bros or anything, but like that, I don't know.
What about boba? You like boba?
I never had a boba.
Yeah. Be careful, because if you're not aware of it, you'll just end up swallowing it.
Like all the thing. But the whole point, like, do we like it?
You like chewing it and everything,
I mean, I like that.
Yeah, it's kind of like candy in a way.
Right, and you can make it more sweet or tart or something, right?
Yeah.
Okay, I might try one of those too.
Yeah,
Maybe I'll just double fist that.
All right, we'll check in with you when you go to Nashville and find out your
board on the ground.
coming up. Powerful conversations from the Bloomberg Sell-Side Leaders Forum. You're going to hear from the U.S. Bancorp President coming up next. This is The Close on Bloomberg. The Bloomberg Sell-Side Leaders Forum is currently underway in New York. This conference brings together business and industry leaders to discuss how financial markets can leverage emerging technologies and also adopt new strategies, digital strategies, to drive growth. Our Manus Cranny sat down with U.S. Bancorp President Gunjan Kedia. Take a listen.
I'll tell you what's on my mind, and it's informed a lot by all the clients we talk to, which cover many, many sectors. But I would say the short-term conversation, because we are bankers, is very focused on cost of capital right now. Interest rates, the shape of the curve, inflation are very present conversations with a lot of our clients in some sectors like banking and commercial real estate. These are sort of quintessential conversations. But they tend to be focused in the short term. There is sort of a longer-term expectation that the inflation story will settle properly in a couple of years. The bigger conversations that are more introspective about long-term trends, which is what we are discussing here. There's a big conversation around technology and AI and what that does to different industries and business model. When I first started hearing it, it felt a little bit like, is this an internet or is this blockchain? And there's a little bit of that doubt, but it feels a little bit more like as impactful as the mobile phone or the internet or the cloud. So that's a big conversation. The second is just labor. Second, very expensive input to almost all business models. Just a lot going on with the workforce. It's getting very expensive for almost every industry. So a lot of conversation there. And finally, I'll capture geopolitics, although I'll tell you, when you talk to a client who's running an agricultural firm in Central Valley, California, geopolitical impacts are very different. They're worried about immigration, seasonal workers. You talk to an industrial company that sells to China, they have a very different level of concern. But those are sort of the conversations that are top of people's minds.
I'd imagine the politics across America are probably much more about America rather than what's going on elsewhere. When I was preparing for this, I went back and had a look at what Alan Greenspan wrote on the 6th of March in the year 2000. And he said this: since 1995, output per hour in the non-financial corporate sector has increased at an average rate of 3.5%. That is nearly double the pace of the preceding quarter of a century. For anybody in the room that wasn't around for Alan Greenspan, he had a thing or two to do with the Fed. So with that in mind, I mean, when you look, let's talk about the technology piece.
Yeah.
From what you've seen, from what you've experienced, and you've been in this banking industry a reasonable length of time, are we about to embark on some kind of major productivity shift, as we're all talking about? Or what can you tell me that sort of matches that? Do you think we're going to see that kind of velocity in the AI technology revolution we're in at the moment?
Well, the question is, we need something, because if you just look back 20, 30 years and what propelled sort of GDP growth across, big labor pools in China and India were coming online at very cheap rates. We probably had the most significant wave of offshoring talent. Women were coming into the workforce. In every which way, the demographics of the baby boomers moving through the workplace, it was a big driver of growth for all of us. So now what are we looking at here? A lot of those trends are reversing. India was the first time not having replacement population growth. So what will create the next level of productivity? The hope is AI. If we can get that kind of a productivity boost out of a technology, it will drive another 20, 30 years. The question is, can it happen? Is there enough energy in the world to have that kind of impact? And how do you harness it? So this is a very big leadership question on the mind of every industry.
That it's U.S. Bancorp President Gunjan Kedia. Of course, he's going to bring in Alan Greenspan. He's channeling some Tom Keene there. Some Boeing news that's coming across the terminal right now. The SEC is scrutinizing statements that Boeing made about its safety practices following a near-tragic January accident aboard one of its 737 MAX 9 planes. So the SEC now is probing Boeing's safety claims after that panel blew off the plane. The stock is still up by 0.3%, but if you just look at the intraday chart, you can just see like a move lower off the highs of the session at the headline crossed.
This is also a stock that's lost 31% of its value so far this year. So I don't know that it's exactly news at this point, or new news at this point, that yet another regulator is looking into Boeing. The other thing, Alex, of course, that you got to keep in mind is that these SEC reviews don't always lead to enforcement actions as well. When it comes to false or misleading statements, they could lead to fines, but that's a whole different animal, isn't it?
Right. But it also feels like for Boeing, just the constant stream of headlines that come across, just to get stability is going to be very difficult, especially when they're undergoing their CEO search at the end of the day. Remember, the National Transportation Safety Board said the panel was missing 4 bolts to hold in place when it left Boeing's factory. They're kind of figuring out what to do about Spirit Aerosystems at the same time. Yeah. None of this makes that any easier.
It doesn't make it easier, but at the same time, they're making planes that all these airliners need. So demand is still there.
Isn't that the truth? That's what happens when you have 2 of them. All right, coming up, we continue to count you down to the closing bells. Micah Cuggino, president over at the Permanent Portfolio Family of Funds, will be joining us. This is The Close on Bloomberg.
This is the countdown to the close. I'm Scarlett Fu alongside Alex Steele. Snooze fest, as you put it, when it comes to the equity markets, when it comes to the bond market.
Right, but not snooze fest for Boeing, although the stock is actually not doing that much. It's off the highs of the session, but that breaking news at the SEC is looking into some safety protocols and safety claims from Boeing after the panel blew off the plane.
Yeah, absolutely. SEC scrutinizing everything, just one of many regulators who's doing just that. Let's bring in now Allison Versperl. She's Bloomberg News aviation regulation reporter. Allison, the SEC looking into statements that executives have made about their safety practices. What can you tell us about what these investigations usually result in?
So, we have, in this case, we kind of have an example of something similar in the past. In September 2022, Boeing agreed to pay $200 million to settle SEC allegations over statements that it had made or didn't disclose about issues with the 737 MAX, in particular related to those fatal crashes in 2018 and 2019. And so these types of SEC investigations, they can lead to big fines for companies, which obviously isn't great for them. And then there's always the public perception as well. But I will point out, right now this is just an investigation. These don't always lead to enforcement action. So I'll make sure to put that out there as well.
Any comment from Boeing on this? What would be their pushback to this?
So Boeing, they just declined to comment. So we're not hearing much from them on this front. This is just one of several legal headaches that they have at the moment. We already know that DOJ has been investigating from the criminal side this incident with the door plug blowing off the Alaska Airlines flight. So it's, one of the many headaches for Boeing of late.
All right, Allison, thank you very much. Allison Versperl joining us there on Boeing. That stock is still up by 0.3% off the highs, but still also off the lows. So take your guidance from where that comes from. All right, in the markets here, we're looking at low volume all across the board in any index that you're looking at. But the S&P is still up by 0.5%. The best performing stock within the S&P is Equinix, and this is a real estate story. That's why the S&P real estate sector is also the best performing sector within the S&P. The Nasdaq 100, though, outperforming. That's kind of interesting. And the Russell outperforming up by a full 1 percentage point. I mean, this is the deal. When you get the S&P doing well, the Russell's going to do well. The question is, can you really trust these moves? Have we sort of done all the selling we needed to do into tax season, Scarlett, and now we're just going to see some relative calm in the market until we get to NVIDIA? I
feel like we're at sell in May and go away, and I recognize that these are all green arrows right now, but there's not a whole lot of activity. There's not a whole lot of conviction right now either.
Yeah, you're just looking for direction. And where are you going to get it? That's the thing. If we're just going to be on hold from the Fed for months and months, where is that direction going to come from?
PPI, CPI, NVIDIA earnings, and then after that, wait for the summer earnings.
In the meantime, buy stocks, buy bonds. That's exactly what's happening today.
The path of least resistance, right? All right. Earlier, we spoke with Amy Wu Silverman. She's the equity derivative strategist over at RBC Capital Markets, and we asked her about the hype in AI names. Take a listen.
We can't just rely on the FOMO and the MOMO and the AI frenzy, which to some degree has been what we've seen from the derivatives market, and some of that momentum has kind of begat more momentum. We can't rely on that tailwind, and that definitely has been a tailwind, Alex. I think it does have to be idiosyncratically the stock does well. That bar has to meet that expectations because you're not getting that tailwind from options, which has usually kind of kept that steam going.
For more market analysis, let's welcome Michael Cuggino. He's president and portfolio manager at the Permanent Portfolio family of funds. Michael, are we seeing a bigger reassessment of the AI play that dominated trade since last year?
I think gradually. I think it gets down to simplicity and common sense, though, and I think Amy's right on a macro level. You're going to need more than hype to get continued gains. Whether they're at the levels we've seen or going forward, you're going to need some substance and growing revenues, growing earnings, seeing how AI is applied to different businesses and how profitably. And so I think that is longer term, the next leg up in that area.
So Scott and I have been talking for the whole day about the lack of volume in the market, what the next catalyst is going to be. Do we have to wait for May 22nd for NVIDIA to come out to really help us understand that dynamic? Or is it going to be CPI? Or is it honestly just going to be wait until the Fed actually cuts?
Well, NVIDIA is clearly important for the reasons we gave, plus the broader market. But there's a whole big market out there with many asset classes besides stocks that are not waiting on NVIDIA. So I think investors have to sort of decide where they want to be, invest accordingly. The two broad themes would seem to be we're in the beginning or middle stages of a continued bull market. There's some validity to that started last fall. It seems to continue to bleed up. It's been supported by corporate earnings. And so that's one direction. The other direction is, are we sort of inching to a stagflation, slowing growth, recessionary scenario? And you could argue that the labor data recently has been softening. The composition of new jobs is not as strong in terms of animal spirits. The news today with new claims and continuing claims, et cetera, gradually going up. Interest rates are higher for longer. So there's those issues that would lead to some sort of leading to a slower growth but stickier inflation environment. And we've also seen stickier inflation data. So depending on where you sit on those two broad stories, you invest accordingly. We would tend to gravitate towards the latter and advocate for a pretty diversified approach.
What's your take on this idea that as much uncertainty as there is, and you kind of encapsulated that nicely with the diverging points of views on what could happen, you have a lot of companies taking advantage of the fact that spreads are really tight and they want to come to market now while they can, while risk premiums are tight. Specifically, you've got more than 40 investment grade firms selling $53 billion of bonds this week through Wednesday. In the high yield space, issuers priced about $11 billion of bonds. What's the take up of that, and what's the risk appetite out there for something like that?
Well, that's an area we love with our fixed income in both our permanent portfolio and our flexible, versatile bond portfolio. So we're basically low duration, high quality balance sheet, finding a lot of opportunities in the shorter space in corporates. And we continue to do that. The yields are competitive. You're not getting compensated right now going out too far in duration. But you're getting very competitive yields and performance. And so for the investor that doesn't want to have to predict too far in the future, but still get a competitive return in bonds, that's an area you want to be. Companies are recognizing that, I think, and it's a reasonably quiet time. You mentioned the lack of volatility and trading volume. It's a quiet time to maybe come to market, get something priced, and get set up. Interest rates could be lower, but the Fed has indicated that they might not be lower for a while. So if you need capital or want to raise capital at reasonable rates and quiet time, this is a good time to go to market.
Michael, where's my safety trade? So if I was nervous, not that I'm saying I'm nervous, but I do like soup cans and gold bars under my bed. But if I was nervous, where would I go put that money while I'm dealing with the uncertainty?
Well, earlier you mentioned some people are investing in stocks and bonds. I noticed you didn't mention gold, and I would have added that in there. I think the market for gold is going to be a strong one going forward. The dollar is very, very strong right now. I don't see that continuing forever. It's been strong for the last decade. There are reasons for that, but still, be that as it may, it's very, very strong right now, and it's likely going to weaken. That's a headwind for gold. Central banks are big buyers. There's a lot of geopolitical risk. There are some countries out there that if they attain a critical mass in terms of creating a currency, global currency to settle transactions in other than dollars, that would be bullish for gold. And retail demand is strong. Plus, you've still got sticky inflation and geopolitical risk. So there's a lot of reasons why you want to add some gold to that mix. I would also say there are other certain sectors of the equity market that are interesting and attractive. I would point to energy and commodities as being one. Areas where you can control pricing power and you can manage your cost structure, areas that pay very good dividends, total return stories that are trading below market multiples. And so I think that's an area in the equity market that is attractive despite, the relatively rich pricing we have right now.
I mean, S&P Energy Index, third best performing sector in the S&P. Utilities is number 2. You can make the argument that's not necessarily just a safety trade anymore. Michael, great to see you. Thanks so much, Michael Cuggino, President and Portfolio Manager over at the Permanent Portfolio family of funds. We're almost there to the closing bell. We're almost there to Friday. We do get the UMich numbers, I think, coming out tomorrow, right? We get UMich, and then next week get the CPI. But I do think it's interesting when you take a look at what's been performing well, utilities, energies, materials, and industrials. Utilities, I think you could put that into the cyclical category now because of the power growth due to AI and the power demand. So it's interesting change, I think, in the sector.
I know you've been talking about this a lot, which I think is really smart. In addition to the fact that they pay that steady dividend and investors are into income, they're obsessed with income, and that's exactly what utilities deliver. And
there are the closing bells. You have green all across the indices here. You have the Dow Jones Industrial Average ending up by 0.8%. The S&P up about 0.5%. The Nasdaq up by 0.3%. Within the S&P, you're looking at 416 stocks advancing just for 87 that are not. A pretty broad-based rally led by real estate as well as utilities, Scar.
Yeah, it's worth mentioning as well that with the S&P 500 back above 5,200, it's at its highest level in a month. Feels like it's been a little bit of a stealth rally back up. I know there's a lot of nervousness about maybe not nervousness, that might be going too far, but there's a little bit of apprehension maybe about some of the AI names that hadn't existed since May. And so, of course, we'll actually get more certainty come May 22nd when NVIDIA reports. But up until then, we're just kind of meandering here as we obsess over every piece of economic data to glean whether the Fed moves with rate cuts at some point this year. All right, let's take a look at the IMAP, which just shows us the different sector performances. Alex mentioned how it's a pretty broad advance, and you can see it right there. If you break the S&P 500 down into 11 sectors, 10 of them are in the green, led by REITs, real estate investment trusts up by 2.3%. Equinix is one of the big reasons. Equinix.
Well, I don't know. Norma Linda next to me says Equinix, right? Equinix?
I say Equinix.
Equinix. Okay.
Equinix.
Well, potato, that kind of thing. Utilities and energy also big gainers, and the red there is from technology.
All right, taking a look at the bond market real quick. We get some earnings coming out, so I want to hit the bond market. You're seeing a bid pretty much all across the curve. You have 2-year yields down by about 2 basis points. You have a 10-year yield down by 2 as well. Now, the real takeaway, though, is that we got 3-year, we got the 10-year, we got the 30-year. We got through all of it this week. The 30 actually was surprisingly pretty good. It was a weaker bid to cover when it comes to the 3, and the 10 was tepid, but it got better and better as the week went on.
Interesting that people want duration.
I don't know. I just report the news, man.
Yeah. All right. Here now.
Yield. It's like over 4%. I mean, it's 4%. It's nice and juicy.
You can get really good yields on the 2-year or the 5-year.
That's true.
And higher yields.
Barbelling.
There you go. All right. Let's bring in Bloomberg's just mentioned and Nora Melinda to help us break down some of the individual movers. Nora, you were saying Equinix?
I say Equinix.
Equinix. Okay.
I could be wrong.
No. We're going to listen to you because that's your beat. So we're going to do that.
All right. Jess mentioned you've been looking at gainers. It's a big up day. What's the big one that you're looking at?
Well, of course, Equinix. However you want to say it. Tomato. EQIX is the ticker symbol on this. So I have to add this. So if you look at the MOV function in the terminal, this is where you can see the biggest contributors on a point basis or percent basis. For a percent basis, it is Equinix, up around 11.5% on pace. So this was actually its best day since March of 2020. This is a real estate investment trust, so it does own data centers. Investors, this is sort of all the rage right now. It's interesting because Barclays was actually noting that usually its earnings report comes out around May 1st. This year it was delayed a little bit because of an internal audit. But Nora actually had a really great story where she was looking at what's happening with short selling for this stock and how actually when you're looking at its biggest gains that it's had recently, how it's sort of upending some of these short bets right now.
For sure. I mean, I think that this is a really big name, specifically in the data center REIT space. Everyone's really focused on it. But the news of today that was really spurring the stock along was the fact that it was shrugging off an internal investigation that it was going through into its accounting practices. And so investors are happy that it's over that hurdle. But of course, we're still awaiting what's going to happen with the SEC because it does have a subpoena outstanding for them.
But what's interesting is that this pairs very nicely with the second winner, which you had on your board with the NRG Energy, right? So this is a REIT data center, and then you got the power side.
That's right. And this is just for you because you and I were talking about utilities earlier this week. So NRG is a ticker symbol for NRG Energy here. That stock's up about 8%. So this is its best day since May 6, 2022 here. The stock's up more than 50% year to date. So this is a big play here, like Alex was saying, when you are looking at the sort of utility space. And if you look at the S&P 500 utility sector, it's actually up 15 of the past 17 sessions, up 13% in that span. And that actually compares with about a 3% span for the broader S&P 500 in that. And a shout out to Elena Papina. She's our team leader on equity. She was actually looking at the ROC function in the terminal. It's a rate of change. So if you look at this, it's basically exceeding the depths of in the pandemic as far as how fast over that time span that we've seen the gains in the utility sector. But of course, NRG Energy is one of the big winners when you are looking at this sector, Alex.
And what's remarkable about this stock is that, you think utility, you think, okay, slow, steady growth, big payouts. 58% gain year to date and only a 1.99% yield.
This is what
dividend.
I find so interesting, and Jess had a great piece on this yesterday, is that so you look at utilities outperforming and you think that's defensive, right? But if you're having power growth like we haven't seen in 20 years, is that actually a defensive play anymore? Or are utilities in essence a growth play? Because you're seeing all this power demand and they're going to wind up making a lot more money. I find that thesis to be quite interesting, and I wonder if we've really rebated for that.
Right, that's a great point because a lot of times people think of it as more of a safety trade, but there's definitely so much AI aspect that goes into utilities, as well as also the bets potentially that we could see a peak, at least for now, when it comes to rates and seeing a play in that space as well.
All right, we also have Sweetgreen before we get to your other winner here. Let's go to Sweetgreen, ticker SG. That earnings coming out right now. Revenue for the first quarter beating expectations, coming in 157.9 million. Estimates were for 151.9 million. Now the loss per share, though, a little heavier than estimated at 23 cents versus 18 cents. But same store sales up by 5%, so pretty strong. And they're taking a look at their full year revenue forecast. On the high end, it was revised up as well as the low end, and the same for same store sales. I mean, our producers went to Sweetgreen today, $20 for a salad. They're bringing them in. What can I say?
I was just going to say that. I mean, they've got pricing power in that they have an audience that will go to them regardless, right? Because they want the healthy option. And now that more people are going back into the office, that's definitely going to happen. You see the stock moving up almost 2% in the after-hours trade. Nora, you've been sitting here. You've been educating us on how to say Equinix or Equinix.
Oh boy. Tell us potentially wrong.
Tell us about the movers that you're keeping an eye on. What do you have your eye on?
Well, let's look at some of the laggards. I'm keeping an eye on Airbnb. That was really a topic of today. It posted lackluster guidance for a second straight quarter. And of course, as we think about this in the midst of Booking and Expedia, which we heard from more recently, they're also kind of seeing a bit of a lag when it comes to guidance. So the upper end of the revenue forecast for Airbnb for the current quarter was in line with estimates. And so it expects $2.68 to $2.74 billion. That's versus the street's estimates of 2.74. And it said that Easter coming early this year in March instead of April was actually quite a drag on its key metrics. It says that travel spending will slow ahead of the peak summer season.
I mean, we've been hearing it. You said Booking, you said Expedia. I mean, all across the board. Now, this next one is Roblox. And I was telling these guys on radio, what I know of Roblox is this. My daughter comes in and takes my phone every Saturday and Sunday morning, and she goes into my phone, she opens Roblox, and she plays Warrior Cats on the Roblox.
Warrior Cats?
Warrior Cats.
It's like a whole book thing. They do it's a gaming thing. She makes her own cats. They're in clans. They eat food. They talk to each other. It's a cat clan.
Wait, is she spending money doing any of this?
So Nora brought this up, that you can like easily click on the game and be like, I'm going to spend money. So I don't think that's happening, but this is something to be checked to be sure. However, the numbers weren't terrible, but the stock reaction was awful.
I mean, now I'm curious to know what the age demographic is, but looking at the numbers here, the bookings forecast missed the average analyst estimate. And of course, this is kind of in the midst of the widespread weakness that we've seen in the video game industry as a whole. It expects 870 million to 900 million for bookings, and that's against the street's estimates of 902. So I know earlier we were saying this sounds a bit critical. You know, they came in at 900 million, but the street was looking for 902, and we see the shares tumbling. But it is kind of focusing on its advertising estimate or efforts right now, as well as a recent partnership with Walmart to buy so that consumers can buy physical goods there.
You know, I have mixed feelings about Roblox because my children have spent way too much time on it and way too much money buying absolutely nothing. They're using their Robux to buy, I don't know, virtual things to help them build cats, apparently, or create cat clans.
No, that's like number one thing I'm doing when I get home.
Very
is to make sure it's not happening.
All right. We want to thank, of course, our contributors, Jess Menton and Nora Melinda, joining us, giving us the stocks to watch on this Thursday. Coming up, SoundHound AI's CEO, Keyvan Mohajer, joins us on the back of their soon-to-come earnings report. This is The Close on Bloomberg. Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Steele. We made it. It is Friday Eve. It is the end of Thursday. We got there, guys. All right, let's take a look at where markets closed out on the day. The S&P 500 really closing around the highs of the session. It was a strong equity day pretty much across the board. You can see that reflected in the Russell 2000 up by about 0.9%. The NASDAQ 100, the underperformer, but still up almost 0.2%. And the S&P up by 0.5, really led by utilities, really led by real estates and REITs, as well as energy. And the REIT story is quite interesting, and that's where we get Equinix. We were talking about that earlier. That stock up by 12%. The real news here is that any reporting issues or any reporting questions that they had are now done. They were able to release their earnings, so it's definitely a relief rally, but it's helping the overall index continue to climb. I should point out, though, volume, not good. Not good at all. Really weak volume. Scarlett's been saying, is it a go in May and go away, or is it just full on go away?
Maybe. We're waiting for CPI, but that doesn't come until next week. So until then, just to recap some of the big movers, Alex, of course, mentioned Equinix. Equinix is the best performer in the S&P 500, biggest rally in 15 years. This is the REIT, of course, that owns data centers. We mentioned it. Let's talk about Roblox, down 22% on the day. The gaming giant gave softer guidance than anticipated, citing for one reason, tough comparisons with 2023 when the platform launched on the Sony PlayStation. But our top story this hour really is about AI. Is the AI shine wearing off? There's little evidence of exuberance from the options market ahead of earnings from NVIDIA, which is scheduled for later this month. And of course, NVIDIA has been the poster child for AI excitement. Today, SoundHound AI reported quarterly results. That'll give us a read on just how much companies are adopting its technology. Alex?
All right, and to that point, we're looking at SoundHound AI reporting earnings. Their first quarter revenue growth was up about 73%, and it went to $11.6 million. The company also raised its full year revenue outlook, but I do want to point out the stock is down. Well, now it's pretty much unchanged in after hours, but this is slowing growth compared to the fourth quarter. And I mean slowing like it's not growing 80%, it's growing 73% on a revenue basis. So put that into perspective for us. Let's get more now with co-founder and CEO Keyvan Mohajer joining us. What led the growth? I mean, the numbers are quite impressive. This is really an amazing feat here. 73% first quarter revenue growth. What's leading it?
Thank you for having me. This was, Q1 is usually our smallest quarter, but this was our best Q1 ever. We grew 73% year over year. And if you look at the last 2 years, we nearly tripled our Q1 revenue in just 2 years. And we also announced, a very strong balance sheet of $225 million or more than that. That makes us a major force as one of the only truly AI public companies that is publicly listed. And we're just getting started.
Just getting started. We know that SoundHound started off as a music ID app on your smartphone, and you now offer conversational AI technology. Is song identification still a significant driver of revenue?
We started actually in a Stanford dorm room nearly 20 years ago when I was doing my PhD at Stanford. and I was doing it in speech recognition. So we started as a voice AI company. We wanted to build the tech, and that took 10 years to build our own speech recognition in dozens of languages, our own natural language understanding. And we launched some products along the way. And our first product was a humming search. You could actually hum or sing a song. We could tell you what it is. And it got 300 million downloads. That funded us for the next 10 years, allowed us to not raise a lot of funding. And then we raised a lot of funding after that. But it's still one of our dear products. It's a feature that we actually offer to our customers, like Hyundai cars provide our music ID feature in their cars.
I'm just looking at your stock after hours. Stock is up by 3%. And I know it's unfair to ask the CEO why, but I just feel like it speaks to the high expectations for companies like yours. And that when you have growth of 80% and the next quarter you have growth of 73%, that investors can just go, oh boy. What do you say to that narrative, and what kind of growth rate can you realistically sustain?
Well, I think it's just people have to digest it. There's a lot of positive materials in our announcement. So the first minute reaction is like, even if you look at the last few quarters, hasn't been a good representation. But we went from we've grown 50% or more in the last 4 years, and we've guided that we're going to continue to grow that. So 73% is great. We also had a big milestone of our AI customer service revenue is now about 30% of our revenue. We are in 10,000 locations, from like restaurants to fitness centers to barbershops. We have 100,000 in our pipeline. And that's the AI customer service is what is going to drive most of our growth this year and for years to come.
What's your timeline to turn profitable, Keyvan?
So we have actually guided that next year our revenue will cross $100 million and we will be adjusted EBITDA positive in 2025.
What kind of other companies are you working with? Obviously, the big news from the last quarter was the preeminent AI chip company, which turned out to be NVIDIA, and an investment there. What other companies are investing that you're talking to? What kind of partnerships will develop?
We also announced something with ARM today, and this morning we announced a partnership with a company called Perplexity, very complementary to what we do, both two AI companies, and in fact, SoundHound and Perplexity are both NVIDIA portfolios, so there's a good connection there, and they provide access to online LLMs. So these are LLMs or large language models that actually have access to real-time information from the web, and we have a product called SoundHound Chat AI that we offer to cars and TVs and IoT devices. You can ask questions about, navigation and restaurant search and sports scores. Last year, we integrated ChatGPT, so you could actually ask questions about recommendation and poems and general knowledge, but that information was static and somewhat dated. But now you can ask, when is Taylor Swift coming to town, or what is the mortgage rate?
We don't ask that in my house. We don't ask that. My daughter's going to want to go. No, shh.
Be careful what you ask, right? Keyvan, I want to ask about how in April you announced that you entered into an equity distribution agreement with various banks through which the company may sell up to $150 million of your own shares from time to time. What's the strategy behind this program? Because stock sales tend to be dilutive for existing shareholders.
So this actually was a part of a program we already have. So last year we announced a $400 million S3 eligibility, and we had an ATM facility that we utilized, and that's how we have a very strong balance sheet now. Now, because our profile has been improved, we are able to even upgrade to bigger banks, like Citibank is now joining the program as leading it. We just want to have the optionality. We don't have a time-sensitive need for capital raise. As I mentioned, we have over $225 million of cash on the balance sheet, and our burn is decreasing, and so on. Our revenue is increasing. It's just good hygiene to have the right optionality and we can be thoughtful about it.
Got it. My optionality is key here. Keyvan Mohajer of SoundHound AI, thank you so much for joining us today.
Thanks for
now, coming up on the close, we go live to the Bloomberg Tech Summit in San Francisco. We'll bring you part of our interview with the co-founder and CEO of Reddit, Steve Huffman. This is the close on Bloomberg.
To invest in getting the ad technology right at the same pace as before. And the second part of that question is looking at the advertising market.
We're going to head over now live to the Bloomberg Tech Summit in San Francisco, where Reddit co-founder and CEO Steve Huffman has been speaking. Take a listen.
Private and what we do with it. So behavioral data, what you're browsing, where you spend time, and our privacy policy is pretty short. We don't sell it, we don't license it, it doesn't go anywhere, it's sacred. Now, the public content on Reddit, so most of the content that you see, Reddit is inherently a public platform. Now, the situation that we're in today is different from where we were a year ago, a couple of years ago. And so I looked at it as we have kind of three paths we could take. The first path would be the status quo. We just stay open and permissive. And I think in the past that worked okay. We'd be crawled by Google and others, maybe researchers. Generally, in our view, it made the ecosystem better and healthier. But what's happening now is we're being crawled every which way by commercial entities, by foreign nation states, for who knows what. And so I don't think the status quo is an acceptable option. But then the other option would be, okay, we just shut our doors, which is what literally everybody else has done. Everybody else has shut off. But we believe in the open internet. We like that Reddit content is out there. We like showing up in search. We like that users can find us this way. We love supporting research. We love Internet Archive and things like that. So I think closing off was not the right option either. So now where we are is somewhere in the middle. We want to stay open, but we need to do so on terms that are respectful of our users, of their privacy, that are respectful of our business. And so that's basically what we put out there. Is we said, we're open for business, we'll do commercial agreements, we'll do non-commercial agreements for nonprofits and things like that, we'll support research. But if you're going to crawl Reddit data, you can't, for example, reverse engineer our users' privacy, or excuse me, their identities. Or can't use our data to target them or things like that. There's some guardrails. You need to delete if they delete it off of Reddit, we want you to delete it out of your systems. And so putting some guardrails on how our public data is used is what we're doing.
I want to stay on AI licensing for just a minute more. Around the time of the IPO, there was a lot of conversation, and dare I say even maybe a little bit of hype about the role that these kinds of licensing deals could play in your business going forward. I got the sense, listening to your earnings the other day, that there was a bit less of an emphasis on that. Was that deliberate, first? And second, I want to hear from you how sort of sustainable and predictable you expect that business to be going forward. One analyst said his base case was that eventually this licensing revenue could reach as much as a third of total revenue by 2027. Is that anywhere in the ballpark?
So we are being picky about who we work with. So I just talked about the public content policy. I think that means not every partner is a good fit for Reddit. Our data is extremely valuable. That we're seeing. We're seeing a ton of interest in it. Our data is the content is extremely valuable to us. I think there's all sorts of interesting things we can build with it. Where the data licensing business goes, I think it remains to be seen. Look, it's kind of a new business. We're literally creating this market at the scale that we're at, and so I think there's some really interesting opportunities. We'll do some of these bigger deals, like the one we announced with Google. We'll do smaller deals with like financial institutions, social listening services, things like that, and I'm sure a bunch of things in between. But I think it's hard to put a number on where we think it can go because it's changing and evolving before our eyes.
Is that base case of a third, does that seem like out of the realm of possibility?
It is hard to compete with ads. So I saw that poll. It would look like user economy was winning, which would be very exciting. Facebook did $170 billion in ads last year from a company that's, call it we're a billion run rate. That may as well be infinite. So if we can get to a third of ads, that would be incredible, but ads is just such a powerful, scalable business model. Yeah. That's the one to beat.
You said around the time of your IPO that the FTC is asking questions about the relationship between big tech companies and suppliers of data like yourself. Realize it's early days, but when you think about the pantheon of things that Lina Khan and her team could and should be concerned about, does she have a point? Is there valid concern about the role that these types of relationships can be playing?
I mean, I think it's natural for they and other regulators and lawmakers to ask questions, right? It's a new space. It's an interesting space. There's obviously a lot of conversation and attention on it. What I want they and others to know is that I think there's a middle ground, right? I think the internet has benefited and consumers have benefited tremendously from, for example, Reddit being well indexed into like Google search index, right? That sort of thing. And I think of AI as a, kind of the next evolution of that sort of relationship. So I think that sort of thing can be really powerful. But at the same time, there are players in the space who I think aren't behaving well, who are using our data in ways that we wouldn't like, that our users wouldn't like. And so I think, in conversations like that, one of our goals is to basically educate them. And here's the good behavior we're seeing, here's the bad behavior we're seeing, here's how we think about user protection. And by the way, that's any conversation we have with regulators and lawmakers. That's kind of the point of view we bring, we're pro-technology, pro-progress, but also we try to be, we live by the golden rule, right? We wouldn't want to see things done in a nefarious or malicious way with our content or anybody else's.
Who's breaking the golden rule?
I'm not ready to say that yet.
We'll get you back on stage, Steve, when you're ready to start sharing some of that. You talked about the opportunities to improve user interface on search, doing a better job of monetizing ads on search. You also talked to my colleagues on Bloomberg TV and talked about the appetite for mergers and acquisitions. What areas are ripe for, what areas are interesting to you? And specifically, is there technology out there around search that can be bought versus built?
I think potentially. Look, our first priority is to invest in our own business. And we've got a lot to build, and we've been making those investments. But we've done some acquisitions, about half a dozen over the last couple of years. They've all been very similar, these like small to medium sized, kind of like tech and teams. So maybe a dozen employees. That's been kind of our sweet spot. We haven't done anything huge, but they've been really helpful to us in just advancing our abilities, particularly in AI.
Yep.
And so that's still the kind of the first place we look. As we kind of develop that muscle. I think M&A is difficult. It can obviously be hugely beneficial, but we've also seen companies, maybe get too excited. So, plan A is we build, and plan B is we buy here and there if we can supplement, our skills and abilities.
Is search an area where you think mergers would make sense?
Yes,
or is that a build first?
It's both, to be honest.
That was Reddit co-founder Steve Huffman. And you can continue listening to that conversation by typing live go on your terminal, the Bloomberg Tech Summit over in California. It takes a village of highly skilled engineers, coders, and other workers to power platforms like Reddit. And that's why companies like Andela are rigorous interview process to ensure that companies have access to the best of the best that tech has to offer. I was calling it in our editorial meeting, this is basically a really selective Match.com for tech jobs. So let's see if I was actually right in phrasing it like that. Jeremy Johnson is CEO and co-founder of Andela. Am I right in that? Is it like a super exclusive Match.com for tech people?
Pretty close. It's Andela. Basically, Andela is a global private talent marketplace that makes it really easy for companies to find great technical talent all over the world because we use AI for the matching. And so you can find the best engineers in Argentina or Nigeria and manage paying them and dealing with compliance without having to source it yourself.
So someone described Andela as harder to get into than Harvard. So
that's exactly right.
Talk about the prerequisites. What's needed to be able to have a listing on Andela, to have your name, have your profile included?
Getting into Andela means you are one of the most elite software developers and technologists in your country. So about 60% of our talent comes from untapped markets like Africa and Latin America. And if you can get in, chances are you're ready to work on a global stage and you're ready to show some of the top employers in the world. I mean, we're talking about Goldman Sachs, MasterCard, GitHub, that you can work side by side with their full-time team members, because that's effectively what you're operating as.
What does that mean then for diversity? Like how you mentioned areas in India or Nigeria, they may have really good people that you want to be working with. So how does the exclusivity equal diversity?
It's a great question. So exclusivity and diversity are actually, I think, like really symbiotic. They work in a really effective way. The challenge for diversity is companies not having the ability to tap into the world as a hiring pool. If you have the ability to sift through, I mean, we have over 150,000 candidates on our platform. Those candidates come from every walk of life. It's part of our core mission to connect brilliance with opportunity as a company, to really bring to the forefront great technologists who might come from backgrounds that companies wouldn't otherwise have access to or be able to find because they didn't work at Google last year. And as a result of that, they're just not as well known. We create a platform and almost act like an agent so that companies can find that untapped talent and in the process get faster, higher quality hires.
Okay, so untapped talent and some of the skills that companies are looking for in particular right now are AI skills. What exactly, Jeremy, are AI skills? This is an ever-evolving technology, and AI skills, when Andela started, a decade ago, is very different than what they are now versus in 2 years.
That's exactly right. We were barely talking about this a year ago in the industry, and on Friday, last week, the jobs report came out. Over 10% of every IT job created in the US now has AI as one of the requirements. And that's out of 415,000 open IT jobs in the US. This is just last Friday. And so this is rapidly becoming like the most in-demand area. And at the baseline, what a lot of people are talking about is large language models and being able to train and ultimately build large language models to assist humans in their own jobs. And lots of companies actually come to us for this specifically. It's one of the most requested things people are looking for right now. And it comes down to two things. One is the strategy. It's like, what should we be doing? What are our competitors doing? What are other companies in our space doing with AI? And then two, how do I find, can you help me find people that can help me do it? And we manage both of those.
I feel like the tech job market is weirdly bifurcated. Like you just described one portion of the tech market that would be very tight. Anecdotally, a lot of data analysts, for example, may have a different feeling. There's been tons of tech layoffs in the last 18 months that it feels like it's really difficult to get a job unless you have an in. Can you walk us through how you would look at it?
Yeah, there's a lot of truth to that. So it's definitely a bifurcated market. Net, overall, like jobs in technology in the US and unemployment is still very low. As I mentioned, there are 415,000 open IT jobs in the US today. And so it's relative to the rest of the economy, still pretty hot, but nowhere near as hot as it was in 21. That said, when you look at things like especially AI, but also cloud computing, it's even hotter than it was in 21 because it's come on so quickly. There's about a 3-year half-life for new and emerging technologies in this ecosystem, and that means people are constantly learning from a talent standpoint, but it also is part of why companies have turned to borderless as a method and means of finding great talent. They've realized we can't do this entirely by looking for people within 20 miles of our office, and borderless is the new remote.
So, final question to you, Jeremy. Clearly, your customers are the employers who are looking for this untapped talent in markets where, it's difficult to find, and you help them source that talent. What about the talent itself? How do you go about serving them to make sure that they are relevant in their respective markets and beyond?
Totally. It's a huge part of why talent choose us. It's because we care deeply about the talent experience and helping talent find the job that ultimately will help them be the most successful. So part of our mission is to build towards a world where people can build careers commensurate with their ability as opposed to where they're from. We believe that brilliance is evenly distributed, and that means that just because you were born far from Silicon Valley doesn't mean you can't work with some of the hottest tech companies in the world from your home country. And so we act as talent agents to help make that possible. And that's part of why then companies love working with us, is because the best talent is already on the platform.
Jeremy Johnson, CEO and co-founder of Andela, thank you so much for joining us today.
Thank you.
All right, let's shift gears and move on now to the top three, where we name drop the people who are driving some of the day's most talked about stories. And first up is Stephen A. Smith. The ESPN host sat down with Alex Rodriguez and Jason Kelly on the latest episode of The Deal.
And when they let me go and I went about the business of licking my wounds and then ultimately trying to resurrect my career, what I zeroed in on was mastering the business that I was in and ultimately positioning myself where I would be able to define my worth. And lo and behold, I've had 3 contracts since. And I think it's fair to say that I've kind of figured stuff out a little.
And another one coming, by the way.
Another one coming. My contract ends in June of 2025. I'm sure we'll be talking before then, and hopefully things will work out. But if it doesn't, it doesn't, and that's business, and that's something that I believe I'm going to be prepared to handle. Let's just say this ain't 2009.
Right. Stephen, I do want to go back.
Stephen A. Smith there talking about the difference between making money and knowing business. It's hard to be able to do both well.
Yeah, exactly. I mean, granted, like no one wants to get fired in order to really like jumpstart you, but that clearly is what it did for him. And the thing with him is you either love him or hate him, right?
Yeah.
Which is like a plus, I guess, when you're a TV personality.
Yeah, when you're a personality in general, yes,
Yeah.
because all attention is, you can monetize that, right? Yeah. Okay, you can catch that full conversation on the latest episode of The Deal tonight at 9 p.m. on Bloomberg TV or tomorrow at 7 p.m. on Bloomberg Originals. Let's stay with sports because the second person I'm watching is David Zaslav. He is the Warner Brothers Discovery CEO, and he says he remains hopeful that his company can reach a deal with the NBA to keep airing live games, even though Comcast and Amazon are now aggressively pursuing those same media rights. I would not want to compete against a company like Amazon or maybe Netflix or Apple.
Right, but also what I found so interesting too in Warner Brothers Discovery earnings is like the packaging, right, of Max and Disney Plus and Hulu. It's like, what's that pricing going to look like? And at the end of the day, are we just looking at cable provider stuff in a very different kind of way instead? In which case, like, what's the difference? We didn't cut the cord. We just rebundled the cord in a different package.
The history of media is bundling and rebundling, unbundling, rebundling, all of that over and over again.
And cost cuts.
And cost cuts. Well, that's part of unbundling or rebundling.
Right, and it going towards that TV advertising area. Okay,
Absolutely.
The third person that we're looking at is Tim Cook. Apple CEO has served for far longer than the average Fortune 500 CEO and is older than many of his peers. But the plans for a potential successor may be complicated. This is a great piece from Mark Gurman on Apple. So Tim Cook, in a very long interview with Dua Lipa on her podcast, Dua Lipa,
the singer?
She straight up asked him, like, what's your succession plan? Like, what are you doing? And he gave a very forthright answer. He said, I can step off the wrong curb tomorrow, and my job is to prepare several people for the ability to succeed. And I really want the person to come from within Apple. And Mark Gurman was saying that it looks like John Turnus is the head of hardware engineering, is emerging as that potential successor for Tim Cook.
Kind of disappointing that there's no woman on there.
Yeah.
Jeff Williams, the Apple CEO currently, but I think he's only 2 years younger than Tim Cook, so he's not really a viable successor candidate. John Turnus, who you mentioned, there's also the software engineering senior VP. Deirdre O'Brien, the head of retail, has been named as a potential one, but head of retail is a lot different than head of Apple, right?
Yep. And I also asked too, well, what about the relationship with China? Does any CEO need to have a very clear and good ability to manage geopolitical risk in China? And he was like, yes, a lot of big tech companies have their own special person that also manages China relationships, and how that would then play out in the successor world would also be quite interesting. But I also took kind of offense because he's like, Dua Lipa did the best interview with Tim Cook that anyone's ever done. I was like, man, that really puts us in our space, doesn't it?
Oh, Dua Lipa competing
financial journalist, no good.
Exactly. Dua Lipa is posing a stiff competition for a financial journalist on TV. All right. Should we go back to the markets?
Yeah, okay.
Yeah, let's take a look at how markets closed on day. I mean, there's a lot of green arrows there, right? The S&P 500 above 5,200, highest close in about a month, and lots of green when you look at the sector performances, but the dollar's slightly weaker. And, I guess the big thing is waiting for the next catalyst. What is it? CPI, PPI first, then CPI, NVIDIA? That's a long way away.
It is. Or is the path of least resistance just, buy stocks, buy bonds, sit tight?
That's kind of what's happening right now. This is The Close on Bloomberg. In today's Muni Moment, JP Morgan is using blockchain technology to bring municipal bonds to investors. And the city of Quincy in Massachusetts is taking advantage of this. Joining us for more now is Eric Mason. He is the Chief Financial Officer for the city of Quincy in Massachusetts. Eric, it is so good to speak with you. Your city is a pioneer here, selling $10 million of munis. We're talking about 7-year tax-exempt bonds using JP Morgan's distributed ledger technology, DLT. You're the first to do so in the U.S. We'll get to, why you're selling the bonds in a moment, but just explain to us how that changes the process of placing these bonds.
Yeah, absolutely. First off, thank you so much for having me on. As a public sector finance professional, it's always exciting when we get to be part of a new technology curve. And what this really means for placing any sort of municipal bond in the market is it allows for a much more fluid entry. It allows for greater secondary market access. It allows for quicker settlement, and it allows for a much more secure platform. And one of the longer term goals is allows for the democratization of debt. So it allows us to not just bring the bond into the market, but open the market up to other potential investors who may not have the traditional amount of liquidity available to, say, invest through SMAs.
How did you come up with this, Eric?
It was a long process and discussion. It began about 9 months ago with a discussion between our mayor, Thomas B. Koch, and current city council president, Ann Kane, where we were looking at what was going on in Europe, particularly with Lugano, Switzerland, and how they were able to leverage this technology for quicker settlements and easier access to the market. And kind of one of the selling points was that, if we begin this process, we could one day see, debt be able to be purchased by Quincy residents. So right now, Quincy pays $25 million out in interest, and it would be nice to be able to keep that in the market.
Yeah, absolutely. So you said it started 9 months ago. Was the actual selling of the municipal bonds faster because of blockchain?
Yeah, the settlement was much faster when it initially occurred. The 9 months was mostly on the regulatory side. We're still municipal bonds. We're boring, and we have to stay conforming. So we had to go through a lot of regulations to make sure we were sticking to that.
No, we would never call munis boring. We love munis, nice tax exempt, nice yield. We dig it, Eric. What do you use the money, or what are you going to use the money for?
Oh, we went old school, roads and sidewalks. We thought, let's take this new technology and let's do good old fashioned government. Let's pave some roads and run some water lines.
I love it. I think every city could use some shoring up of that infrastructure. One thing I wanted to mention, and this is something that our reporter on the Bloomberg News side had included in their story, is that Quincy had a bad experience with a cyber attack in 2021. The city's pension fund was attacked. What happened there, and how did that maybe influence your thinking or shape your approach in using this technology?
Yeah, no, that's a great point. I think we had that cyber attack, and we had another cyber attack that didn't result in any loss, but still, made our ERP inaccessible. The retirement system, I'm a member of the retirement board also, but the retirement system is independent. But any loss in our retirement system is a loss to us because we have to, fund that unfunded liability. And one of the thought process for this was, how can we take every step to make the city dollar, the taxpayer dollar safer, both now and in the future when we look at the sale of bonds. And knowing the technical hurdles it takes to break blockchains, that's a big surplus. It's a big, it's a big plus to put there, saying, hey, on our ledger, we're going to put an asset that's just very, very difficult to manipulate, and a very, very difficult thing to even have enough computing power to alter.
This is a really dumb question, but do you know who bought them? Were there new investors who came in that did it that wouldn't have before? Did you notice a material difference?
Yeah, so we get, when we do negotiated debt, we get a lot of interest all the way from SMAs to BlackRock and all the big guys. This was directly taken down by JPM. And so we're kind of examining who's going to be the guy on the secondary market who works with JPM and see that transfer. I got to tell you, the secondary market aspect of this, my background's in economics, so anything to do with trade and exchange, I'm very curious to see how the secondary market works, because I think that could really be what suppresses interest rates in the long run with this technology.
Oh, interesting. All right, we're going to check in with you down the road then once you find out more and you're able to kind of evaluate everything and give us a read on whether it does increase accessibility of these muni bonds to perhaps the residents and citizens of Quincy. Eric Mason, thank you so much. Eric Mason is Chief Financial Officer of the City of Quincy in the state of Massachusetts. Coming up, we are live from the Bloomberg Tech Summit in San Francisco. We're going to bring you part of our conversation with the COO of OpenAI, that is Brad Lightcap. This is The Close on Bloomberg. Alex, you made the point earlier that it's Friday Eve. Of course, tomorrow is Friday. There are things on the calendar we need to be mindful of, starting with what's happening in Europe.
Yep, so you got the ECB accounts. That's coming at 7 a.m. The real deal is this is kind of like the minutes. You can get insight.
Thank you. Translation.
The idea is that ECB is definitely going to cut in June. They have telegraphed that by far. The question is what they do after. There seems to be no idea and no consensus yet, so that's going to be quite interesting to see what they're starting to think about that.
So one and done, or is this the beginning of something
Right, which is different than here, which is it feels like once we cut, then we'll continue to cut. We just don't know when. So difference there.
Yeah, well, let's take take things one step at a time, right? All right, speaking of how things are done here, there's going to be a lot of Fed speak on the calendar. Austin Goolsbee, Lori Logan, Bowman, Barr, Kashkari.
I feel like you name it, it's there.
Yeah, it's like a roulette wheel of like, which Fed speaker do you want to hear from?
Well, and you didn't put on the UMich thing. We get UMich, preliminary read in May. That actually moves markets now. It's a good sentiment indicator, particularly inflation expectations. And we've seen a lot of the soft data coming in really light or not great, especially NFIB or ISM services, ISM manufacturing kind of starting, services rolling over. I'm into that.
Yeah, so that's another read on the economy, and that'll dovetail with the Fed speak. And I didn't mean to add the word dove and give any kind of indication of what we might hear. But,
Understood.
in any case. Also, Xi Jinping, he's been on this great European tour. He's going to wrap things up tomorrow.
Yeah, but no one else agreed with me, but I thought it interesting he didn't visit Germany, considering that the German car market is very dependent on China. He went to France and then Poland and Hungary, so it was countries that aren't necessarily
the crux of Europe.
Right, and also maybe more friendly to Russia than otherwise. I found that to be very interesting as well, so it'll be interesting to see kind of the takeaway from that. And then, of course, kind of how we close. I do feel like how we close the week will then set us up for next week when we do finally get some economic data that could move the market in the form of CPI. And we still have earnings trickling out. I think we can start to get the retail numbers next week, like Walmart. So we'll get another read on the health of the consumer. Whereas McDonald's, not great. Starbucks, not great. Cracks for Amazon in terms of the consumer, not great.
So you have this economy that on the surface is doing very well, but there are cracks appearing, and certainly the anecdotal from the companies would suggest that there's a lot more cautious behavior coming from consumers, which drive this economy, and that's starting to pick up steam as we head into the summer season. You're seeing that with the anecdotal from companies that rely on consumer spending money to go travel as well.
Yep.
All right.
Interesting.
If you look at total M&A volume in the first quarter, that totaled about $352 billion, which is up 70% from a year earlier, and the highest for the period since 2022, according to data compiled by Bloomberg.
And the rebound of deal activity after a prolonged drought has been boosted by the comeback of mega deals like Capital One buying Discover. Andrew Bednar is partner and CEO of the global investment banking firm Perella Weinberg, and he spoke to the team over at Milken.
Take a listen.
So we've got a lot of encouraging signs. You've got larger deals. You've got some significant stock-for-stock deals. The boardrooms are very active, and I do think that's a harbinger for future activity. But it's a slow walk back up, but it's an encouraging one.
Andrew, why are companies doing deals? Because they have to or because they want to?
So strategics are leading us out of this trough in M&A. So it's clearly a strategic-led market. I think sponsors will follow. Strategics are faced with the same pressures they've typically had, which is growth. So they're looking at how much can they continue to grow the top line in a late-stage economic expansion. Most economists will say GDP is probably a single digit for the USA, and emerging markets may be a multiple of that, but most of the developed markets are single digits. A lot of action has happened in the middle of the P&L, cost cutting and other supply chain improvements that have been made post-COVID. You have capital going back to shareholders for dividends and buybacks, but that's not enough to satisfy equity investors who want 12, 13, 14% equity returns. So how are you going to get that? You have to look externally, and that's where M&A becomes.
All right, let's go back to the Bloomberg Tech Summit in San Francisco, where OpenAI COO Brad Lightcap has just begun speaking.
Reinforcement learning, where you were training these agents to basically be superhuman at any given task. And so we were applying that to try and beat humans at video games. We actually had a project where we had an agent play the best Dota players in the world, if anyone's familiar with Dota. And we were taking the same principles and doing research into robotics to see if we could actually teach a robot hand how to manipulate a Rubik's Cube. And so I was sitting here in 2018 trying to figure out what exactly would our business be were we to ever be a business. And I was like, I guess we'll be somewhere between a gaming company and a robotics company. And Reed actually was very helpful in helping us think through this early on, the real Reed, not the fake Reed. And so we ultimately were kind of like looking at that, but it felt really early still. And then when transformers came out and language models started working, it really felt early on like that was going to be the thing that was important.
Makes sense. And OpenAI's mission is to build AGI, right? Artificial general intelligence that could one day potentially surpass our own mere human intelligence. What do you say to the many people, including prospective customers, who are still pretty freaked out by that, right?
Yeah, look, AGI is obviously an ambitious goal. I don't think anyone, by the way, has a perfect definition.